The Irish Life brochures Reuben received pointed to all the advantages and gave a very clear demonstration of how Irish Life claimed the endowment mortgage could deliver a massive surplus over and above the traditional mortgage. It spoke of convenience and flexibility, but nowhere in the documentation does it say there is a risk that the mortgage will not be repaid.
In my mind, I can't say whether they warned me or not of a risk, but I was aware myself that there was a bit of a risk, but that was only a small risk in my mind. I felt that it was going to pay off well.
And it looked like that for quite a while. In 1998, Irish Life told Reuben that if his investment grew by 6%, he was on target to pay the mortgage. In April 2000, they said the same. They repeated the promise in 2001. By 2002, they told him his fund was performing generally satisfactorily and still held out the prospect of a surplus. But in May of this year, all bets were off. Even if his fund continued to grow by more than 6%, he was heading for a very large shortfall.
The feeling was that it would pay off early or else give me a nice little lump sum at the end. And that was always the case up until this last year or so when I got a letter. I remember sitting on the couch and suddenly reading this unexpected news that it was coming in short. I, in 4 years' time, will have paid off this mortgage, and depending on predictions, I could have a shortfall of between €5,000 and €7,500.
It was all about three things: sales, sales, and sales. The industry wasn't measured by any other benchmark. It was about your increase in sales each year, and it didn't really matter about the quality of the product. At the end of the day, your remuneration and the entire way the industry, right from the ground floor right up to boardroom, was driven by increasing sales, without really much thought given to product construction or value to the consumer and so on.
Earlier this year, we decided to carry out a survey of the endowment mortgage market. And we did that because we realised that these were sold predominantly in the 80s. A lot of them might be coming up to maturity over the next 4 or 5 years. And we were a little bit worried that we had very, very few calls to our helpline. We'd had 17,500 calls to the helpline, and of those less than 10 related to endowment mortgages. So we were wondering, were people aware of the situation that they might find themselves in who had bought a product earlier on, and to be aware of those risks. So we decided to carry out a survey, and we're in the middle of that now.
But that survey is confined to the industry. It is not aimed at the customers, so it's unlikely to pick up the thousands of dissatisfied people who've already got rid of their policies. Davnet O'Rourke took out a £30,000 mortgage over 20 years from First National, underwritten by Scottish Provident in 1988. 5 years and 2 houses later, she cashed it in.
In 1988, we would have borrowed 30,000 when we went to the bank, it was First National at the time. It was advised that we would take out an endowment policy. We were told this was the way to go. Everybody was doing this. We were guaranteed, more or less, that it would pay for the mortgage, plus you would have a little nest egg at the end of it. And we took it. The covering of the mortgage wasn't even really that important. You understood that that was covered, but you would have extra money at the end of it.
Davnet kept meticulous notes of her finances. When she noticed that she was paying more than her friends and that question marks were appearing over endowment mortgages, she decided to get out.
I certainly had no idea I was getting into sort of a fluctuating situation, that there was a chance that it wouldn't perform. There was no detail given to me at the time. It was just that by paying this, it was like an insurance, as far as I understood it, it was like an insurance thing, that you're paying it, and that from the end of the day, this will pay and cover the rest of the mortgage, and you'll have a bit left.
By cashing her policy early, however, Davnet lost out on a bonus, a key element of the endowment system. It's another gain for the life companies because they generally keep the bonuses that are left behind.
Really, to me, the bonus system is the raison d'etre for endowment mortgages. They're on a win-win-win situation, a bookmaker's dream. They know that the very high percentage of people will never get to bonus. They'll never have to pay it. That's why you have associated financial groups that are in the business of buying endowment mortgages. they will take them over. Let's say you're on a 20-year endowment mortgage and you're up at year, say, 13, and bonus is paid over the last 5 years of the policy, as is the case in my one. You will find people out there that want to buy that off of me because I've already taken the hit at the start, and they're there to take the gravy at the end, the bonus. Now, it's gravy to them, but it's not the same gravy to you because you've taken the hit.
Andy O'Loughlin operates a successful endowment exchange. The bonus system means he can pay more for some policies than the early surrender values quoted by life companies. How does it work that you're able to pay more?
Because our calculations, and it's a kind of a very complex sort of an area, are that the policy is worth more than the surrender value being quoted to them.
How?
Well, they sign a contract on day one for, say, 25 years with, may I mention Life Office? Well, let's say they sign a contract with, say, Standard Life for 25 years on day one, and they want out after 16 and a half years. And Standard Life, quite rightly, would say, look here, they wouldn't say it, but it's implied. You signed up for 25 years, you want out after 16 and a half years, we'll give you X, 12,000. I look at that then and say, what might this be reasonably worth in 8.5 years' time? And if I work backward, is it worth somewhat more than 12,000 now? And if it is, there's a market.
Well, when you take the risk, you do it with your eyes open. You know what you're getting
yeah.
into.
I mean, if the bonuses are cut after I buy a policy, that's I won't be complaining to anybody.
And that element of risk, which you're prepared to accept, which you know what you're doing, do you think that most people, when they bought these policies, understood the risks involved?
No. That's a straight answer. They didn't.
Why would the financial institutions, reputable institutions, pull the wool over people's eyes like that? Have you thought about that?
Have I thought about it? I have. The first and straight answer is money, greed. There's absolutely billions involved.
But the biggest losses by far were made elsewhere. Politicians and regulators just had to take notice. Here in the UK, the issue of endowment mortgages has become a very hot topic. Millions of people have been affected, and more than €1.5 billion has been paid out to consumers in compensation. Politicians and regulators just couldn't ignore it. The British Consumer Association has been pushing the issue very hard, and the financial services industry has had to hang its head in shame.
You had a bunch of rapacious investment companies and insurance companies who were exaggerating the benefits of a complex product, but actually downplaying the risks associated with that product. And as a result, we estimate that up to 5 million people in the UK may have been missold a mortgage endowment policy. So far, around £1 billion has been paid in compensation to those people who were missold, but there's still a long way to go yet.
We've seen something of the order of about 70% of mortgages now getting letters saying there may be a shortfall. And that's been a big increase over the last 3 or 4 years. And that's starting to focus people's minds on it. And we think that will continue as people start to get their second letters.
Last year we received 50,000 mortgage endowment complaints. This year we're already on track to receive 60,000 mortgage endowment complaints.
But that's just the tip of the iceberg. The true figure is 10 times that amount, because the Ombudsman Service says it gets just 1/10 of the formal complaints that are made, and it's the life companies that are being blamed.
The fact that it was the bank that provided the mortgage isn't relevant to us, because the complaint isn't about the mortgage in the sense of the loan. The complaint is about the investment product that was sold to pay off the loan. So it's an investment complaint.
I suppose the fortunate thing is that most of the policies that were sold to consumers happened after the original Financial Services Act. It came into force in the UK in 1988. That meant whenever advisors and insurance companies and so on were selling products like endowment policies, that they were supposed to make sure that the product was appropriate and was suitable for the consumer. I.e., they had to make sure that people were comfortable with the risks associated, that they understood the risks, and indeed that it was suitable and appropriate for the purpose it was intended for.
The point is that to a large extent, the rules that came into force in 1988 only codified what was already, we would say, a legal requirement on the part of any professional at any time. we call that duty of care. So in other words, even before 1988, any advisor, we believe, would have had a duty of care to their clients. And it's only the duty of care responsibilities that became, as I say, codified in 1988 that changed things. It doesn't necessarily change that underlying responsibility on the part of a bank, building society or insurance company to give effectively advice that was appropriate before that date.
So people have been compensated for policies which were sold when there was no legislation in place?
Yes, yeah.
And that's a standard thing here?
Oh yes, and now probably half the mortgage endowment complaints we get relate to sales before 1988.
What about Ireland? I can't claim to be an expert in Irish law, but it seems to me that, you know, that there must be a basic case for consumers to be able to challenge the nature of these contracts. I think the essence of the mortgage endowment mis-selling was that basically the insurance companies and their advisors simply misrepresented the nature of these contracts. They exaggerated the benefits and they downplayed the risks, and I don't think the contracts have actually lived up to consumers' reasonable expectations.
The British regulator has concluded that endowments were a complicated mortgage sold to a mainly uninformed public by commission-driven salesmen. They involved the upfront payment of up to 20 years' worth of fees and effectively imposed a financial penalty on anyone who wanted to cash out early. In most cases, the risks were not adequately explained, and there was certainly no mention of the premiums ever having to go up. That's why so many people in Britain have received compensation and why endowments have become such a big issue. But the products involved, the way in which they were sold, and in many cases the companies involved, were the exact same as those that operated in Ireland. Yet the Irish regulators and politicians have done very little about it. The Irish regulator says people might not have complained here because no regulation was in place at the time. But they point out that contract law would still apply. Pursuing that, however, would involve a lot of expense.
The legal system isn't really geared for guys like me. For example, in the instance I'm talking about, they would look for, say, $2,000 up front to get an opinion. And to pursue the matter further, they would look for payment as we go along. And to go to the High Court, they would look for a payment of somewhere between 100 and 200,000. And they would be telling me that it's not on a no-fault, no-fee basis. So, I mean, the system is geared against me, shall we say.
IFSRA is keen to help in this process. They will assist in tracing those who sold endowment policies, but their power to take action is still limited.
You may believe, well, there's very little I can do about this because I understood that risk. The risk has materialised, and now I need to take action to make sure that I can actually make up the shortfall in some way. But there's also a category of people who may believe that the product was sold to them as being a very low-risk product, that they didn't fully understand what the issues were. And those people, we would strongly advise them to contact the person who sold it to them and explain why they believe they were missold that particular product.